Welcome to the Stock Market Palantir. Today we are going to talk about KULR.
KULR Technology Group is, it's perhaps the most bifurcated equity profile we've seen in the microcap sector this year. I mean, it's a company that has radically redefined itself, moving from its established NASA heritage thermal engineering consultancy model to what management terms the strategic triptych.
Precisely. This triptych, which, consists of kinetic defense manufacturing, a definitive Bitcoin-first treasury mandate, and a unique, highly volatile market microstructure, has set up a fascinating conflict. The central question for investors is whether this radical convergence creates a fundamentally, structurally asymmetrical opportunity with massive long-term upside, or if the acute financial strain inherent in such a rapid, costly transition makes KULR an unsustainable, highly speculative risk.
And that is exactly where our perspectives sharply diverge. I am profoundly concerned with the immediate, and I'd argue existential, financial deterioration. We see it most clearly in the Q3 2025 results. This strategic shift, while ambitious, it just relies too heavily on constant shareholder dilution, making the equity fundamentally fragile and overly dependent on volatile external price movements, namely Bitcoin, rather than sustainable internal execution.
I see why you think that, and the financial results certainly raise red flags. But I approach this from a different angle. My focus is entirely on the enormous long-term upside derived from this operational pivot. KULR is moving aggressively into the high-growth, high-multiple defense technology sector, specifically targeting counter-UAS directed energy systems, or DES. When you couple that potential with the guaranteed asset appreciation driven by the substantial, established Bitcoin treasury, I believe the market is simply and deeply undervaluing KULR's trajectory right now.
Okay, so let's hear your position on that.
To elaborate on that upside, we have to look at the successful operational shift away from just consultancy. KULR has executed a critical pivot toward a sector that commands much, much higher valuations. The November 2025 prototype announcement of the 400V battery system for counter-UAS directed energy systems is the key inflection point here. This announcement successfully moves KULR from a scienced project valuation, which is where thermal engineering consultancies typically sit, toward a defense prime supplier trajectory. They are solving a fundamental physics problem related to these directed energy weapon systems.
That's an interesting point about trajectory, but we have to ground the discussion in reality. I mean, prototypes and promises do not pay the bills. The operational pivot is, quite frankly, financially perilous. It's crossing what manufacturers often call the valley of death. Let's look at the immediate financial reality of Q3 2025. Revenue surged 116% year over year to $6.88 million, which on its face suggests explosive growth.
And the product growth up 112% is confirmation that the market is rapidly adopting their modular KLUR1 platform, which is absolutely critical for scaling.
It is confirmation that they are moving product, yes, but we have to ask, at what cost? This is the core issue. Gross margins collapsed catastrophically, falling from a robust 71% in Q3 2024 to a shocking 9% in Q3 2025.
That is a staggering drop.
It led directly to a widening operating loss of $8.74 million for the quarter. This margin collapse reflects the heavy, low-margin drag from two primary sources: the initial Bitcoin mining setup and ramp-up with the Soluna partnership, and the inherent inefficiency and high startup cost of early-stage product manufacturing.
But that required investment in scaling, even with the accompanying temporary margin deterioration, is already reflected and, I would argue, discounted in the current market price.
I am not convinced the market has fully priced in the consequences of this liquidity situation. Not at all. Because the company's current financial model ensures perpetual dilution. They have raised an incredible $107.3 million via at-the-market, or ATM, equity offerings in the first 9 months of 2025 alone. This alarming rate of cash burn necessitates these massive offerings, effectively transforming the existing shareholder who thinks they own a promising defense manufacturing IP into a leveraged participant in an actively managed, high-risk Bitcoin fund, and it's funded entirely by continuous equity dilution. That structural issue is the risk the market is truly focusing on. on.
Okay, so let's zero in on that conflict because it is the fundamental debate here. The viability of the long-term defense pivot versus the immediate margin collapse. You focus heavily on that 9% gross margin, arguing it signals massive inefficiency. We saw the cost of revenue skyrocket up 580% in the quarter, largely due to depreciation, energy costs, and production ramp-up from the Saluna mining operation. So your question is, how can the market possibly justify a growth multiple when the quality of earnings is so profoundly low?
The margin collapse is the entire story in the short term. An $8.74 million quarterly operating loss is unsustainable without constant equity raises. The market cannot simply ignore a negative 72% decline in gross profit while simultaneously celebrating revenue that is only being generated at a razor-thin 9% margin. The core business is hemorrhaging capital.
That is a compelling argument, and the drop from 71% to 9% is undeniably severe. But have you considered the structural context of the valley of death in hardware transitions? The low margin is a temporary symptom of scaling and an intentional choice to buy long-term growth. They are aggressively investing in R&D, which increased by 89% in the quarter to $2.32 million, specifically to transition to high-value defense contracts.
Okay.
The key is the potential for a high-value recurring revenue stream starting in 2026, once that 400V CUAS system moves from a prototype status into a confirmed program of record. This transition fundamentally changes the revenue mix away from low-margin services and initial mining setup toward high-value proprietary defense product deliveries.
But hardware firms typically need gross margins in the 30% to 40% range to support R&D and scale efficiently. Until that 2026 contract materializes, the capital expenditure required just to keep the lights on is enormous. The problem I see is that the defense procurement timeline is notoriously slow and subject to political volatility. If that program of record is delayed by a quarter or two, the cash burn rate is immediate, meaning another dilutive ATM issuance is unavoidable.
The critical insight here, though, which I think justifies the burn, is the technological moat they are building. KULR's carbon fiber velvet thermal material solves what the military calls the pulse power problem. Directed energy weapons like high-energy lasers, or HELs, require massive, instantaneous bursts of energy. Managing the heat generated by these rapid, high-power pulses is extremely difficult physics. KULR's material provides a sustainable, reliable technological advantage in thermal management that few, if any, competitors can replicate quickly. That capability justifies the high cost of the current ramp-up.
It certainly provides a technological advantage, I'll grant you that. But how much is a future technological advantage worth if the present balance sheet is structurally unsound? And that brings us to the second pillar of the strategy, the BTC treasury. You believe the Bitcoin-first mandate is fundamentally accretive.
I absolutely do. KULR has explicitly stated they are executing the MicroStrategy playbook. By Q3 2025, they had accumulated $120.5 million in BTC holdings. They are using high multiple equity shares of KULR to acquire a scarce appreciating asset like Bitcoin. The goal is to provide investors with a tax-advantaged proxy on Bitcoin appreciation while strengthening the balance sheet and, theoretically, lowering the effective cost of capital for the operating business.
I come at that strategy from a completely different perspective. I'm sorry, but I just don't buy that the BTC yield metric, which management loves to highlight, is anything but highly reflexive and potentially misleading. Yes, the balance sheet looks robust because of that $120 million in volatile assets, but this entire strategy creates a distinct liquidity trap that they cannot easily escape.
Could you elaborate on what you mean by a liquidity trap in this context?
Well, despite having over $120 million in volatile assets, KULR remains fundamentally cash-constrained due to the $8.74 million operational deficit. They are trapped. They are trapped because they cannot easily sell down that treasury to cover their massive operational deficit without signaling a complete, panic-driven loss of confidence in their core Bitcoin-first strategy. Selling the treasury would be an admission of failure in the operational pivot and a massive psychological blow to investor sentiment.
Right.
Therefore, they are forced to do the next best thing,
which is the worst thing for shareholders. Dilute via the ATM to cover day-to-day losses. If the stock trades poorly, say below $3, issuing shares at those levels is massively dilutive to the underlying operating business's book value. They are caught between needing cash and needing to maintain the BTC strategy's credibility, making the ATM the default destructive solution.
The counterpoint is that they intended to deploy the ATM proceeds directly into BTC acquisition, which they did. $79.7 million of those proceeds went straight into Bitcoin purchases. The intent is clearly laid out: turbocharge Bitcoin accumulation. The structure is built to appreciate the asset base, not to fund the operational deficit long term. The strategy fundamentally works if and only if Bitcoin appreciates and the defense pivot reduces the operational cash burn by 2026. The two are complementary, not contradictory.
But until 2026, the entire capital structure is leveraged to that volatility. What happens when Bitcoin inevitably hits a severe bear market? Their asset shrinks, the capital raised from the ATM is suddenly worth less, and they are left with a 9% gross margin operating business that still requires $8 million a quarter to run. This reliance on external price volatility brings us directly to the unique market microstructure that appears to be influencing KULR's price.
Exactly. And I believe the microstructure supports my long-term thesis that the stock is technically suppressed, not fundamentally weak. The significant sum of the parts, or SOTP valuation gap, is undeniable. When you apply a valuation methodology that takes the Bitcoin treasury and then applies a conservative 3x to 5x sales multiple to the defense segment's projected run rate, well, the implied share price range is calculated conservatively between $6 and $10. Trading around $3, the stock suggests a deep suppression of fundamental value.
I agree there is a valuation gap, but that gap doesn't necessarily imply institutional positioning. To me, it implies risk is being correctly and aggressively priced. The microstructure signals extreme speculative risk, not undervaluation.
I disagree about the interpretation of the technical factors. The microstructure suggests technical suppression, not fundamental weakness. We see persistently high off-exchange or, dark pool trading volumes, consistently exceeding 60% of total volume. This is crucial. Dark pool trading is generally characterized by large institutions executing massive orders away from public exchanges to mask their intentions. When over 60% of volume is hidden, it fundamentally dampens true price discovery. These institutions are either hedging their Bitcoin exposure or positioning aggressively for the defense pivot, holding the price artificially low.
That high dark pool activity, however, must be viewed alongside the indicators of short pressure. The extreme short interest, around 15.8% of the free float, and the anomalies we see in the fails to deliver, or FTD data, suggest that volatility and operational dilution risk are what the market is truly focused on.
And just to clarify for listeners, fails to deliver occur when a seller's broker is unable to provide the securities on the settlement date. High FTD spikes are often seen as a symptom of heavy short selling pressure.
Precisely. And these high FTDs, combined with the structural dilution, confirm the market's caution. Furthermore, the 1-for-8 reverse stock split they executed in June 2025 is often interpreted bearishly by retail investors as a sign of desperation, and the price action post-split confirms this skepticism. The current price of around $3 reflects the market's collective view that the immediate operational risks, that devastating 9% gross margin, outweigh the potential premium derived from the Bitcoin treasury. The market is skeptical of what some call the delusion scam narrative.
But those specific FTD spikes we saw in mid-October, which coincided with local price tops, indicate aggressive shorting into rallies. When those FTDs are eventually cleared, it requires forced buying activity, which ultimately acts as a stabilizer for the price floor. I maintain that technical factors are fighting the fundamental strategic value. There is an arbitrage opportunity here for institutions that can see past the temporary margin pressures and understand the long-term shift.
Okay, let's wrap this up.
My thesis remains that KULR is a high-beta, asymmetrical wager on the convergence of two powerful, potentially exponential trends: directed energy defense technology and Bitcoin financialization. While the financial cost of executing this pivot has been high, evidenced by the low margins and significant cash burn, the successful prototype delivery into the CUAS space, and the establishment of a substantial appreciating Bitcoin treasury lay the essential groundwork for significant and rapid re-rating that could be driven by a confirmed defense contract or a sudden, sharp Bitcoin breakout.
That's a strong summation of the rent's upside. But the investment thesis requires the market to fundamentally ignore the immediate, severe financial realities. The catastrophic collapse of gross profit and the reliance on continuous dilutive financing via the ATM are not minor growing pains that are simply priced in. They are fundamental flaws in the current operational and capital structure. Until KULR can demonstrate genuine operational efficiency, until they can restore gross margins to a sustainable level in the 30 to 40% range, the equity remains fundamentally cash-constrained and overly dependent on the reflexive, high-risk dynamics of using equity to chase volatile digital assets.
Extreme volatility and conflicting signals, record revenue juxtaposed against a record operating loss, a high sum of the parts valuation against a very low market price. It all highlights the critical importance of analyzing both the strategic promise inherent in the defense pivot and the detailed complex market microstructure to form a complete and balanced understanding of QLRR's current state. This is a complex hybrid equity where the risks and the rewards are equally extreme, and only time will tell which strategic pillar proves strongest.
Thank you very much for hearing us. Let us know in the comments what is your opinion, and if you want us to analyze other stocks, don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.